Guardbonds lineup is a suite of defined maturity bond funds that are actively managed by Guardian Capital LP and really set themselves apart within the Canadian marketplace. If you take a look at the vast majority of fixed income funds available to Canadians today, they are managed in perpetuity, meaning there's no defined end date to them. The underlying bonds are constantly being bought and sold, and so as an investor in a fund like that, you have very little clarity or peace of mind around knowing what your potential return experience could look like over any given horizon. The Guardbonds lineup helps to address that very issue. So let's take, for example, the Guardbonds 2025 investment grade bond fund. The fund itself matures on November 30th of 2025. The underlying bonds that it holds also mature in 2025, in fact, as close to that November 30th date as possible. And what this provides you as an investor is a lot more clarity around what your cash flow experience could look like over that time horizon, and puts a clear flag in the ground to say this is the date at which your principal or your original investment amount will be returned to you. The other distinguishing feature that's very important about Guardbonds is our explicit focus on tax efficiency. And the way that we do that is by buying up as many discount bonds as possible in the portfolio to provide you as an investor a greater amount of capital gains as a proportion of your overall total return relative to simply providing you with interest income, which we know is taxed at a much higher rate. Fixed income has been a very challenging place for investors to navigate over the last couple of years. We have seen a massive influx of capital moving essentially to the sidelines in cash alternative solutions like high interest savings account products, money market funds. And I think that's been a pretty good trade for investors over the last 18 months or so, where they've been able to get, let's say, 5% plus on these types of securities. But I think the consensus view today is that we have likely peaked in terms of interest rates, and any moves from here are likely going to be cuts. So as an investor sitting on cash, just be cognizant that as interest rates start to come down, you're very likely going to have less cash flow generating ability in your cash allocations. So what to do with it? I think it may make a lot of sense to allocate some of that cash to something like Guardbonds, which provides you conservative fixed income exposure, but really lets you capitalize on the current levels of yields that we're seeing, and in a way almost lock in those yields for 1, 2, 3, or 4 years, depending on the fund solution that you buy into. But beyond why now, I think the beauty of the defined maturity structure provides you with peace of mind regardless of when you buy. So I think as investors, we become so anchored on near-term volatility, but when you know that you have a maturity date down the road in 6 months or a year's time, that interim volatility becomes a lot less relevant. So we're big advocates of working with an advisor, first and foremost, to help navigate your individual circumstances. But if I was to provide more generic comments, I would say, absolutely, as I alluded to, you can look at your cash allocation to the extent you have some, and think about putting that back to work in something like Guardbonds that provides you with conservative fixed income exposure while giving you the potential to earn higher return, particularly within your taxable accounts based on the tax efficiency of the Guardbonds lineup. But maybe further out on the spectrum, there could be an opportunity to trim from your core fixed income positions, those that may have a longer duration or maturity profile, and that may not necessarily align with your individual time horizon or risk tolerance. So I think what the thing with the Guardbonds lineup is that it really lets you get more precise and targeted with aligning your investment exposure with your individual time horizon and cash flow needs.